Welcome to Dad Gives Advice. In this video, I'll be covering retirement accounts. Now, if you're young, don't stop watching because this is just as important for you, or maybe even more important for you than it is for older folks. The sooner you start with investing in retirement accounts, the earlier you'll get to a point where you'll be financially independent and be able to control your own destiny. Before getting started, I'll remind you that the content in this video is for educational and informational purposes only. Each individual is different, and you should seek the personalized advice of a financial advisor in order to tailor a financial plan for your specific situation. Work with an advisor before taking any action. So first of all, why should young people even care about retirement accounts? Let's look at a couple of examples. If you saw my video on index fund investing, you know that the S&P 500 returns around 10% per year on average. So we'll use that growth rate in all of my calculations on this video. If you invest $6,000 per year, starting at age 20, by the time you're 70, you'll have $7.7 million, roughly speaking. Now, if you wait until you're 40 years old, let's say you start investing $6,000 a year at 40, then by the time you're 70, you'll have a little over $1 million. So which 70-year-old would you rather be? That's why it's important to start early. You want to have many, many decades of investing, in this case, 50 years versus 30 years. That 20-year difference can make a big difference in your final amount. There are two general types of retirement accounts that I'll cover here. One is called IRAs, or individual retirement accounts, and the other is called an employer-sponsored plan. So let's talk about IRAs first. Traditional IRAs were created by the government in order to incentivize people into saving for retirement. The deal with a traditional IRA is that you can put away a portion of your earned income every year into a traditional account, and then that money can grow tax-free until you start to withdraw funds after the age of 59 and a half. So you can put away $6,000 per year. That's the current max that you can do for folks under 50 years old. And the growth on that money, or the capital gains and the interest that you earn in that account, will grow tax-free. So every year you won't have a tax bill on this account. And that's a great benefit because the taxes aren't being withdrawn. And so you're able to compound your growth even faster than you would had you had to pay taxes on capital gains throughout that entire period. And what happens is, at the end, once you do start to withdraw money, that's when you get taxed on your gains in the account. Also, if you don't make too much money, you can actually deduct that $6,000 every year from your income. So that means that your income is actually reduced by that amount, and then you pay taxes on whatever is left over. So if you make $75,000, you can actually deduct that $6,000 from your taxes and then only get taxed on the remaining, which is $69,000. So right there, you're saving a bit on your tax bill. There's another kind of hidden benefit here, which is that theoretically, when you retire, you might be at a lower tax bracket than when you are working. So let's say, for example, if you're working and you're making $150,000 a year, you might be like at a 35% tax bracket, let's say. But when you retire, you might not be taking that much money out of your IRA. So your tax bracket at retirement might be lower. Let's just assume, just for the sake of argument, it's going to be 20% at retirement. So in that way, you're saving money as well, because rather than having this money taxed at a 35% rate while you're working, you're going to have the money that grew taxed at a 20% tax rate when you're retired. And these numbers could vary depending on how much you have at retirement. You may end up at a higher tax bracket at retirement, but that's an example of what could happen as well with an IRA at retirement. If you're married and only one spouse has earned income, you can actually deduct an additional $6,000 for the spouse that does not have earned income, an additional $6,000 per year into the spouse's own IRA, even if that spouse doesn't have their own earned income. So that's a total of $12,000 that you are putting away into two different accounts. And by the way, $12,000 per year over 50 years, from the time you're 20 to the time you're 70, turns out to be about $15.4 million. Not bad. Contributions for a current year IRA can actually be made up until April 15th of the following year. So for the tax year 2022, you can make contributions into an IRA as late as April 15th, 2023. There are penalties for early withdrawals and excess contributions, so consult your advisor before moving any money around or before trying to add more money than you should into the account. IRAs are held typically at a financial institution like Vanguard or Fidelity or broker-dealers like that. You can transfer IRAs from one custodian to another, but make sure if you do that to do a direct custodian-to-custodian transfer and not have the money pass through your hands at all. If the money does pass through your hands, you may be liable for high fines and high taxes as a result. Again, consult your advisor to make sure you do this correctly. There are certain conditions under which you can take money out of your IRA before age 59 and a half and not incur a penalty like death or personal disability or medical hardships, but you should definitely consult an advisor before taking any action before the age of 59 and a half. You're not forced to take money out at 59 and a half. You can actually wait until you turn 72. And at 72, you're then required to take what are called required minimum distributions. And they must start at least by April 1st of the year after you turn 72. And if you do take a distribution on April 1st of the year after you turn 72, you must also take the second distribution by December 31st of that same year. And you have to take those RMDs every year thereafter. If you don't take an RMD when you're supposed to, there is a whopping 50% penalty on that. So be very careful there. Many older folks fret about RMDs, but I say, hey, if you're paying taxes after all those years of tax-free growth, then you're doing fine. Just pay for the cost of civilization and just enjoy the rest in your golden years. Another option for IRAs that has been growing in popularity over the last few years is called the Roth IRA. And the difference with the Roth IRA is that you don't put money in before taxes. Don't put in pre-tax money. You put money in after it's already been taxed. And then the benefit of doing that is then the money then grows tax deferred, just like a regular IRA, but you would then withdraw it without having to pay any taxes. So it's a really nice benefit there. And in order to do that, you have to have the account for at least 5 years. Now let's talk about the other type of retirement account that I mentioned earlier, the employer-sponsored plans. Employer plans for short. The most common of these is called the 401k. And this is a plan that's set up by your employer, and they work typically with a financial firm to set that up. And once they have that established, you can start to defer income to invest in the plan. In 2022, you can defer up to $20,500 or $27,000 if you're over 55. What that means is that you're able to take some of your annual earnings and invest it into this account. An additional benefit is that money is reduced from your tax burden. So let's say if you make $100,000 a year and you defer $20,500, rather than being taxed on $100,000, your tax is going to be based on $100,000 minus $20,500 or $79,500. Which is a nice tax savings right there. For example, if you're in the 30% tax bracket, this will save you around $6,000 per year. That's $6,000 per year less than you'd have to pay in taxes. Nice. On top of that, many companies that have a 401k plan will also do what they call employer matching on a portion of your deferral. So they'll say if you put in at least 6% of your pay, will match 3%. So in that case, if you're making $100,000 a year, you put in $6,000 and they will then give you $3,000 as a match for free, just for participating in the plan. So it is a no-brainer to at least do that. If your employer has a 401k plan, the very least you should be doing is contributing the minimum amount you need to contribute to gain the maximum employer matching. Doesn't make any sense not to take that free money. By the way, that free money of $3,000 over 30 years could grow to something like $500,000. So take the money and run. The rules and penalties for distributions and early withdrawals are about the same for 401ks as they are for IRAs. Again, consult your financial advisor on that. Employees of nonprofit organizations, public schools, and tax-exempt organizations like hospitals have other plans that they can take advantage of called 403Bs and 457 plans. And these are very similar to 401ks with just slightly lower contribution limits than the 401ks have. For all of these different retirement plans, I would use index fund investing that I went over in my index fund video. And remember that was very generic advice that I had in there. So it's a rule of thumb kind of thing, and you should work with an advisor to tailor your investments within these funds in the way that's best suited for you. You should also remember that you and your advisor can move money more freely inside of a retirement account than you would in a taxable account. So rebalancing of this account is not going to be as difficult as it would be in a taxable account, because whenever a sale happens inside of one of these accounts, it's not a taxable event. The taxes come at the end of the period once you start withdrawing funds once you're in retirement. My recommendation is that if you have a retirement plan at work, you should take advantage of it as soon as possible and start deferring some of your income to lower your taxes and growing your investment account as soon as possible. Don't wait until your 30s or 40s, because the earlier you start, the faster your money will grow and the larger your overall end nest egg will be. If you can't max out your contribution at first, at least put in the minimum amount that you need in order for you to get that maximum employer match, and then increase your contribution as you get more raises and promotions. If your work does not have a sponsored retirement plan, then set up a personal IRA and max that out to $6,000 per year as soon as possible. Remember, though, to only commit money that you will not need until you're at least 59 and a half into these accounts. If there's money that you're going to need earlier to make a big purchase or to fund a kid's college education, that should be saved and possibly invested in a separate brokerage account that is a taxable account, or kept safer in an ordinary bank account. In employer-sponsored plans, you're not going to have the full range of choices for index funds and other kinds of investment vehicles that you will have when you're working directly with a brokerage company within an IRA. It'll be a smaller set of funds that you'll have to choose from that the company has set aside within the plan. Now, in many cases, you might find some index funds in there, and I would recommend that you use those, or at least you use the lowest cost funds that are in there. This would be another case to work with a financial advisor to help you pick the best funds within the set that you can choose in your retirement account. When moving from one job to another, you should consider rolling your 401k over into an IRA. This is so that you don't have any ties left to that employer and your money or your account isn't subject to any changes that the plan administrator might make after you're gone that may be detrimental to you or your account. This rollover should be done as a custodian to custodian transfer so that you can avoid any kind of penalties or taxes that might be due if the money were to come through your hands. That's what I have on retirement accounts. Let me know if you have any questions, comments, or any other topic suggestions. Thanks for watching and have a great day.